Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about Russian oil supplies. Alexander Novak, who's the Deputy Prime Minister of Russia, has announced that Russia has decided unilaterally to cut its supplies further by another 50,000 barrels per day. So that equates to more than 18 million barrels per year, which is roughly around 1% of what Russia is exporting. Now, this latest announcement follows on from the previous production cuts that Russia announced of 300,000 barrels in September and 500,000 barrels back in April. So in total, Russia has cut back by 850,000 barrels per day of its supplies. And just to put that into context, prior to announcing these cuts, Russia was exporting around 5 million barrels per day. So this is a material amount. Now, the reason that Russia says that it's doing this is to try to balance what's happening with supply and demand. A lot of the oil producing countries that are part of OPEC Plus have signed up to production cuts over the last 12 months to try to keep the price high. They're trying to earn more per barrel on a lower supply rather than flooding the market and seeing prices continually going down. And the reason that prices are going down is because we're in the middle of a global slowdown. So the demand for oil has fallen. But there's a really fine balancing act here for a country like Russia, because if you cut your production too far, then even if the price of oil does go up, overall you'll be earning less income because you're selling less barrels at a higher price. So in today's episode, what I want to do is go through the details of this latest announcement. We'll have a detailed look at what's been happening with the price of Russian oil and also Brent crude oil, which is driving these production cuts. We'll talk about whether or not these production cuts have been successful, because OPEC Plus have announced significant cuts over the last 12 months. But in the face of that, the price of oil has continued to fall because the global economy is actually slowing down at a faster rate than OPEC Plus is cutting oil prices. We'll also talk about what's happening in the USA, because the shale oil fields are producing significantly more oil than everybody expected. And that's offsetting a lot of these cuts from OPEC Plus and therefore not having the desired effect that Russia is intending. And then finally today I'll wrap up with my summary as to what I think the impact of these production cuts and also the fall in oil prices is having on the Russian economy and what's likely to happen over the course of the next 3 to 6 months. But before we get into all of that, I'd like to say once again, thank you so much to everyone that supported the channel. If you bought me a coffee or sent me a super thanks or signed up as a patron or a member, really appreciate that. Thank you so much. This chart shows the movement in the price of Urals crude oil, which is Russian oil, over the last 12 months. And the reason that I wanted to go through the details on this is to assess the impact on Russia's revenue of the production cuts that they've announced over the last 12 months. In July 2023, Russia announced that it was cutting its production by 500,000 barrels per day, which equates to around 10% of Russia's total exports. Russia produces over 10 million barrels of oil per day and exports around 5 million of those. In September 23, Russia announced that it was cutting a further 300,000 barrels of oil, and the most recent announcement has stated that they're going to cut another 50,000. So in total, over the last 12 months, Russia has announced production cuts of 850,000 barrels per day, which equates to a total production cut of around 310 million barrels per year. So in terms of calculating the amount of revenue that Russia is losing as a result of these production cuts, the current price that Russia is achieving for the sale of a barrel of oil is $59. So that means that the production cut of 850,000 barrels equates to lost revenue of $50 million per day, which equates to more than $18 billion of lost revenue over a 12-month period. However, the situation is much more serious than that. This chart shows the movement in the price of Russian crude oil over the last 5 years, and the reason that I wanted to expand the time horizon here is to show the price of oil that Russia has been achieving since its invasion of Ukraine. In February and March, the average price of a barrel of Russian crude was trading for more than $90. The average price fell in April and May to around $80 as the sanctions started to kick in against Russia. However, by June, the average price was back up to $90 as the global price of oil rose and Russia managed to export more volume to countries such as India and China. However, as you can see from the chart, between June 22 and March 23, the average price of a barrel of Russian crude fell significantly, and in March was trading for less than $50 per barrel. And the reason I want to go through this analysis is to gauge the impact of the general fall in oil prices on Russia's income. Prior to the announcement of the recent production cuts, Russia was exporting around 5 million barrels of oil per day. And at an average price of $90 per barrel that Russia was achieving in the months following the invasion of Ukraine, that equates to $450 million per day, or around $164 billion per year. So if we now look at the impact of the reduction in oil prices on Russia's revenue, at the current price of $59 per barrel, Russia would have been earning $295 million per day if it was still exporting 5 million barrels per day. And on an annualised basis, that equates to around $108 billion. So a reduction of $56 billion in the annual income that Russia is earning. However, obviously Russia isn't exporting 5 million barrels of oil per day anymore because it's announced production cuts of 850,000 barrels per day. So in addition to the $56 billion of income that Russia has lost as a result of the price fall, they've also lost an additional $18 billion as a result of the fact that they're now producing less oil and therefore exporting less oil. So the combined impact of the fall in price and the production cuts has led to a loss of revenue for Russia of over $74 billion. This chart shows the movement in the price of Brent crude oil, which is the benchmark price globally, over the last 5 years. And the reason I wanted to look at this is to look at the impact of the previous announcements by both Russia and OPEC Plus on the oil price. Now, in terms of the impact of Russia's invasion of Ukraine, you can see that at the end of November 2021, oil prices were down to around $69 per barrel. However, oil prices started to rise significantly as global concerns about the potential for Russia invading Ukraine started to rise in December and January. The invasion itself started on the 24th of February, and that sent oil prices skyrocketing to more than $120 per barrel, which was the highest level that oil had been at for 8 years. However, the problems that are being caused by the war in Ukraine were overtaken by a slowdown in the global economy in the second half of 2022, and as a result of a reducing amount of demand for oil, prices started to fall. And by the end of September 2022, they were down to around $83 per barrel. At that point, OPEC Plus stepped in and tried to drive up the price of oil by cutting supplies. And the consortium of members announced that between them, they were going to reduce the global supply of oil by 2 million barrels per day. Now, as you can see, the immediate impact of that announcement was that it had the desired effect on oil, and prices rose to around $96 per barrel by the end of October 2022. However, the continued slowdown in the global economy reduced demand further, and by the middle of March, oil prices were down to $72 per barrel, a price that hadn't been seen since the end of 2021. In response to this, OPEC Plus announced in April of this year that they intended to cut global supplies by a further 1.1 million barrels per day, and the immediate impact of that announcement was that prices rose to above $85 per barrel. However, they quickly returned back to around $72 per barrel. Oil prices started to rise again between June and September as hope started to rise that interest rate increases had come to an end across the world and that recovery was starting to take place. However, over the past couple of months, concerns have started to resurface about the performance of China and other major economies, and by the end of November, the price of a barrel of oil was back down to around $75. Now, interestingly, the most recent announcement at the end of November that OPEC Plus intends to introduce a further cut of 900,000 barrels per day has had virtually no impact on the price of oil. We haven't seen a major increase, and there are two reasons for this. Continued concerns about the global economy in 2024, and the fact that the USA is now producing significantly more oil, which is partially offsetting these cuts from OPEC Plus. OPEC's nemesis, US shale, is rearing its head just months after the sector was all but written off as a threat to the cartel's sway over worldwide oil markets. Drillers from the Permian Basin in West Texas to the Bakken Shale of North Dakota have ramped up oil production well beyond what analysts foresaw, pushing output to a record just as OPEC and its allies put the brakes on supplies in a bid to arrest oil price declines. This time last year, US government forecasters predicted domestic production would average 12.5 million barrels per day during the current quarter. However, in recent days, that estimate was bumped up to 13.3 million, the difference being equivalent to adding a new Venezuela to global supplies. That growth is reverberating around the world, calling into question OPEC's strategy of curbing supplies to prevent the potential catastrophic price impacts of a glut. It also makes clear that the legions of companies that pump oil from US shale fields still yield enough power to bedevil the cartel's efforts. The US clearly played a huge role in the global markets in 2023, including pressurising OPEC Plus to curtail their output. OPEC Plus tried to check the influence of North American shale as early as 2014, when the group flooded world markets with crude in a bid to recapture market share from the ascendant US oil sector. However, the move aggravated an existing supply glut and triggered a 65% plunge in crude prices that took 14 months to bottom out. That collapse sent a jolt through the economics of US shale, ending years of breakneck production growth. And although the expansion eventually resumed, it was thrown into reverse by the global pandemic in early 2020. The shale industry emerged from that setback with a resolve to prioritise returning cash to investors instead of chasing production gains. Meanwhile, in the years since the 2014 to 2016 sell-off, the OPEC Plus alliance worked to enforce supply quotas among member nations as part of a broader strategy of balancing global supply and demand to maintain robust prices. The recent announcement by OPEC Plus of a further million barrels a day voluntary cuts won't inspire much confidence, as smaller member states have little incentive to abide by its terms, and larger ones may not reduce exports due to seasonality. US shale growth and a recovery in Iranian and Venezuelan output could effectively offset all the additional proposed cuts in 2024. Part of what makes the US crude surge surprising is that companies are managing to increase production even as the number of drilling rigs at work fell roughly 20% this year. That productivity gain has confounded many analysts and researchers who have long relied upon so-called rig count as a predictor of future crude output. Explorers are squeezing crude oil out of new wells more efficiently because of innovations in everything from electric pump technology to new strategies for deploying workers while fracking wells to minimise downtime. A key example of this has been the replacement of the iconic decades-old pump jack with high-tech underground gear as tall as 3-storey buildings that sit inside a well to push more crude to the surface. A shale well isn't finished when the drilling is done. A separate array of workers and gear is called upon to frack it so that crude can begin to flow. It's the last and most expensive part of oil production, and frackers have achieved similar efficient gains, shortening the process by 3 days to little more than a week per well. Every year we're seeing more efficiency, Chevron Chief Executive Officer Mike Wirth said during a recent talk at the Council of Foreign Relations. The role of private producers may also have caused forecasters to underestimate oil production because their activity is harder to model than publicly listed peers who report earnings every quarter. Out of the 10 fastest growing producers by volume since the pandemic, 7 of them are private companies. So what's the summary and conclusion today? Well, I wanted to post this video because I think it's important to look at what's going on with Russia's oil industry. Now, Russia is part of OPEC Plus, and OPEC Plus are leading the charge in terms of reducing the amount of oil that's being supplied into the international markets. And the logic here is that by reducing supply, it therefore increases the price, because if demand stays stable and you reduce supply, simple economics tells us that price goes up. But the problem that Russia and OPEC Plus has is, firstly, demand is not remaining stable. Because of the global slowdown, demand is actually reducing. So even though OPEC Plus and Russia are cutting the supply, if demand falls at a faster rate than supply is falling, then prices will still go down. And that's exactly what we've seen from the data today. We looked at the charts, and over the last 18 months, there has been a significant fall in oil prices because demand is falling. OPEC Plus and Russia are trying to do their best to arrest the fall in prices, but it's simply not working. And the other factor at play here is that there are supplies coming from other producers who are not party to OPEC Plus. The problem that OPEC Plus and Russia has is that it doesn't cover the total global supply of oil. So unless everybody signs up and agrees to cut production, their individual production cuts may not actually reduce the global supply of oil. And what we've seen in today's video is that the USA is experiencing a boom time right now. Back in 2014, OPEC Plus tried to break the US. They actually did the opposite of what they're doing today. They flooded the market with oil to drive prices down, to try to put a lot of the American companies out of business, because they'd worked out what the break-even price for a lot of those companies was, and if they were able to push the global price below that, potentially there was a chance that a lot of those companies would go bankrupt and therefore not be in a position to increase production in the future when prices went back up. Now, interestingly, that strategy did cause a major crash in oil prices, which would have hurt all of the OPEC Plus members. So they were doing this to try to drive competition out of the market so that over the long term, they would be able to have a stranglehold on oil supplies and therefore be able to dictate what the global price should be. But it didn't work, and the US companies survived, and as we've seen in today's video, they've actually become more efficient and they're producing a lot more oil than everybody expected, around 1 million barrels more, which is offsetting a lot of the cuts that have been announced by OPEC Plus and Russia. Now, if we look at what's been going on with Russia specifically, they've just announced a further 50,000 barrels of oil cut, and that's on top of the 300,000 and the 500,000 that they announced earlier this year. So in total, 850,000 barrels of oil have been cut from Russia's supply schedule, and they're exporting around 5 million barrels. So this is a significant chunk. And as we saw from the analysis, this is hurting Russia for two reasons. Firstly, the production cuts have led to a direct loss of around $18 billion of revenue for Russia. And that's at the current price. If we were looking at historic prices, the impact would actually be much greater than 18 billion. So those production cuts will hurt the Russian economy. But the bigger impact is actually what's been happening to oil prices. As the global price of oil comes down, so does the price of Russian oil. And those price falls over the last 12 months have led to a loss of income of more than $50 billion from Russia's point of view. And the total impact of the production cuts and the price falls is around $74 billion. Now, that is an absolutely enormous amount of cash. And the problem that Russia has is that this isn't the end of the story, because prices are continuing to fall. OPEC Plus are doing their very best to keep prices up. But as we saw from the data, even though they've announced a series of cuts, it hasn't had a long-term impact on oil prices, partly because countries like the USA, Iran and Venezuela are filling the gaps left in the supply chain from the reduction of oil from OPEC Plus. So it's not working, and it's highly likely that if the global slowdown continues as it's expected to in the first half of 2024, then oil prices will continue falling, and that will lead directly to a reduction in revenue for Russia because their oil sales will be falling again. Now, interestingly, on this topic, I'm in the process of preparing a video right now looking at the official figures that have been published by Russia for November 2023. And they show that oil and gas revenues are down 63% against what Russia was earning in 2021, which was the last year that was unaffected by the war in Ukraine. So that tells us that the Russian economy is seriously struggling right now. I know there'll be a lot of comments in the section below saying Russia's actually doing really well. It's doing better than it was before it invaded Ukraine. But the official figures that we're seeing coming out of Russia don't support that. And the fact that Russia is continuing to announce unilateral cuts in its production does raise the question as to whether Russia is currently struggling with its production, because these cuts are not having the desired effect in terms of boosting Russia's revenue. They're not having the desired effect in terms of increasing oil prices. So is Russia actually cutting its production because it's producing less oil and therefore doesn't have the same amount of oil that it had previously to supply the export markets? As we've discussed before, a lot of companies left Russia at the time of the invasion, and they've lost a lot of expertise. And some of these drilling facilities are in areas that have really extreme climates, very, very cold in the winter. And there is a possibility that Russia could be experiencing production problems right now. And without that expertise and also the access to the technology that Russia has lost as part of the sanctions, there is a genuine risk that Russia's producing less oil and therefore having to cut its production as a result of production problems. So the overall summary of today's video is that Russia has now announced its third voluntary cut in production. Those cuts in production are having a direct negative impact on the amount of revenue that Russia is earning. The ongoing fall in oil prices is making the situation worse. And over the next 3 to 6 months, it's highly likely that Russia will continue losing revenue as a result of continued price falls for oil and also as those production cuts hit home. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.